Hello, hello. We have people trickling in now. Just give it a few seconds here. Excellent, excellent. Okay, I see people in the room. Hello and welcome everyone to today's webinar here at Plan First Wealth. Today we will be covering the 9 major differences between UK pensions and US retirement accounts. For everyone here, I want to thank you all for attending. I'll be your host today. My name is James Boyle. Need to start with a quick disclaimer. Plan First Wealth is a registered investment advisor. The information presented today is for educational purposes only. Plan First Wealth does not provide any tax and/or legal advice and strongly recommends that clients seek their own advice in these areas. Now, in a minute, we're going to talk about Q&A, so I'll leave that to my colleague Richard here. But note, if you will, the button at the bottom of your screen that says Q&A. All right. Without further ado, I'll hand over to my colleague Richard, who will start with today's agenda.
Thanks, James. So in a minute, we'll tell you who we are and why we think we have the authority to talk to you about this. I will then spend a quick minute telling you why financial planning is different for Brits in America or British expats in America. We'll then get on to the main topic, which is the 9 major differences between UK pensions or UK retirement accounts and US retirement accounts. And then finally, I'll spend a minute explaining to you how we think expats can optimize, who will really make the most of their opportunity that they have here through our expat optimization system. We will have a dedicated question and answer session at the end. However, as we go along, if you have questions, please throw them into the chat. If we can deal with them as we go along, we will. Otherwise, we'll get to them at the end. So please don't be shy. Ask away.
Absolutely. We want this to be loose, dynamic, so send them through. A quick introduction of who we are. We are Plan First Wealth. My business partner, Richard Taylor, founder and CEO of the firm. I am James Boyle, lead financial planner here at Plan First Wealth. Worth noting that we are both dual qualified in the US and the UK. You can hear my accent. You've heard Richard, so you know that you have a Brit and a Yank. We do work together to serve British expats in the States. In fact, that is our entire mission. It is helping expats navigate and thrive in their cross-border financial lives. So to kick us off, why is financial planning so different, Richard, for expats?
Because it is way more complex and because the the stakes are higher. The consequences of a wrong move, primarily because of the US, are way more draconian. So think back to when you were back in the UK, you had one system to learn, one system to worry about, one system to navigate. And it was a learning curve. Then you move to the US, and there are similarities, but there are also major differences. And now you have 2 systems to learn. Arguably, depending on what state you're in, California, Connecticut, I'm looking at you and some others, you have 3 different systems to learn. But then most of all, you not only have to learn these new systems and these new systems, but you have to understand how the 2 systems interact, how UK pensions operate in the US, how US pensions operate if you're back in the UK, how ISAs operate in the US, and how these 2 systems interact is generally governed by the tax treaty. And the tax treaty is full of ambiguity and grey areas. So, I mean, frankly, most Brits don't ever fully learn the UK system, and most Americans don't fully learn the US system. We have to learn 2, maybe 3, and then we have to learn how they interact, and with all the itinerary, the additional grey areas and ambiguity that come from that, and then you layer on top of that, primarily because of the US, the penalties, the cost, the potential cost of getting some of this wrong that the US imposes, and mistakes can be very costly. So it's different in that it's more complicated, way more complicated, and it's potentially more expensive.
Absolutely. That interaction piece is so critical and something we talk about a lot. I'm going to throw this up on the screen for just a minute here. I will come back to this after we go through the content of today's session. Obviously, this is meant to be an overview, right? Your facts and circumstances are going to be unique. So if anything we say today resonates, If you'd like to learn more, we have created this QR code. This links directly to our diary for all attendees of today's webinar. We are offering a no cost, no obligation, a 30-minute exploratory Zoom. We'll get to know more about you, what your current goals are, your current situation, and how we might be able to help. If you don't like QR codes, which I know some people don't, you can email us at james@planfirstwealth.com or richard@planfirstwealth.com. Stick in the subject line meeting. We'll reply and get something booked in. So again, I'll have this up again at the end, but in case there is anything we touch on today that you'd like to discuss further, feel free to take us up on this offer. All right, without further ado, we'll get stuck into the main content, starting with number one, tax treatment of contributions. A lot of people on this call will know UK pension contributions are typically made pre-tax, right? So you get that tax relief upfront at your marginal rate. In the US, slightly more complex story. You'll hear me refer to this theme many times today in that it will vary greatly sometimes by the account type, by the plan type you have available to you. So a quick sort of table setting, contributions made to a traditional retirement account. Think of your traditional 401k, your IRA. These are similar to those UK pension contributions, right? You get the tax relief up front, then those accounts are tax deferred. Growth is deferred until you start taking withdrawals, which we'll talk about in a second here. Key differentiator in the US, Roth accounts. Now, these come in different sorts and flavors as well, but put simply, they are funded with post-tax dollars, after-tax contributions. They then offer tax-free growth. So if you're still working, if you have a Roth account, you could be looking at 10, 15, 20, 30 plus years of dollars that are growing in those Roth accounts. When you go to take distributions, they're completely tax-free. The complexity in the US also introduces then different opportunities, right? So you'll hear all kinds of strategies thrown about in the Roth conversions. Those are a big one and particularly attractive to expats. These are strategies that are unique to the US environment. You absolutely want to be sure, number one, you understand them, right? You know what they are. And then number two, how it might fit into your cross-border financial plan. Asset location, another consideration, right? Very often, the people we work with are heading into retirement with a basket of different tax vehicles, call them, right? Roth accounts, traditional accounts, UK pensions, UK accounts. You want to make sure that you're holding the underlying investments in those accounts in the most tax efficient place possible. Again, these are all table stakes for heading into a cross-border retirement. You want to make sure that you're incorporating this into your planning. Okay. Flip side of contributions, let's talk about taxation of withdrawals.
So broadly speaking, the concepts or the philosophy the two systems are based on are the same, right? You put money in, and it's tax deferred. You get tax deferred on the way in. You get tax-free or tax-deferred growth, or I guess tax-free growth and income, dividends income as the accounts grow over time. But then withdrawals are taxed as income on the way out. Now, in the US, if we put Roths to one side for a second, these fantastic tax-free accounts, but for the regular traditional IRA and 401ks, all withdrawals are going to be taxed as income. You get tax deferral on the way, tax deferral on the way in, tax deferred growth, but fully taxed as income on the way out. And the UK is broadly the same. A key difference in the UK, though, is this concept of PCLS, pension commencement lump sum. This is 25% tax-free lump sum, I'm sure most people on this call have heard about. Now, that can be taken as a lump sum, or it can be taken as each income payment. Each income payment can have 25% that's tax-free. Now, this comes back to what I said at the beginning. Is this tax-free in the US? Well, it's unclear. It's governed by the treaty, and the treaty is ambiguous. There is a case for it being tax-free, and there is a case against it being tax-free. And it comes down to the individual taxpayer and their tax advisor and the positions they want to take, and then ensuring that they document it correctly. And this is kind of like the poster child of this ambiguity, this grey area that can exist when we are forced to rely on the tax treaty for the final rule. And then furthermore, there are some states where it almost certainly is taxable. So broadly, high level, the treatment is the same. Distributions taxed as income. For the UK, we have this additional wrinkle of the PCLS, the 25% lump sum. That is unclear. And in fact, in a handful of states, it's basically essentially taxable.
You have to deal with 50 state regimes in addition to the federal government. Everyone's favorite complication. Number three here are minimum distributions, what you might know of or hear of as RMD. So this is a US specific term. Essentially, the IRS requires withdrawals after a certain age for certain accounts. Right now, they currently begin at age 73 for most retirement accounts. That's going to be your traditional, your pre-tax, right? So if you have sizable 401k accounts, if you have sizable IRA accounts, you want to absolutely be aware of what those distributions are going to be once you reach RMD age. This is a critical part of what we call income planning as you approach retirement. In other words, where are you taking income from and when? If those distributions are high, if you find that you have to take large amounts of distributions, that can bump you into higher marginal tax brackets, right? So what are you doing to mitigate that, or at the very least incorporate it into your plan, knowing that the tax hit might be higher than you had originally anticipated. The UK doesn't have a direct analog to RMDs. Retirees can draw down pensions at their discretion. There is one wrinkle here, as there always is and will be. Richard's going to touch on estate planning complications, inheritance tax in particular, and changes that were made to UK pensions recently that can have some pretty serious downstream effects and something you want to be aware of. So more on that in just a minute here. But keep in mind that you want to be incorporated RMDs, required minimum distribution planning, into your US accounts, certainly. How about access age, Richard?
So both systems, US and UK, restrict access. Start with the US. In the US, the access age, the age where you can start accessing your retirement savings penalty free, is for the most part 59 and a half. There is an exception if you have a 401k from your employer and you retire from that employer and you leave the 401k there. Sometimes you can access it from 55. Certain conditions have to be met. That's an exception. Generally, for most people on this call, practically everyone, the access age will be 59 and a half. In the UK, there's also an access age, and that's currently 55, although that is rising to 57 from April 2028. So if you're in your early 50s now and you're banking on accessing your pension, you need to try and work out whether you're going to get caught out by that or not. It will, from April 2028, the access age for UK pensions will rise from 55 to 57. And unfortunately, if you're caught by that, there's nothing you're able to do but wait. A big difference comes in if you need access before these ages and whether you can actually get access. So for a UK retirement account, SIPs, pensions, whatever you want to call them, before the age of 55, you're essentially not getting any money out. There is an exception, and that is if you have a terminal illness. And that's not a joke. If you can document a terminal illness, you might be able to get access to your retirement savings early. But short of that, you're simply not getting money out of your UK retirement accounts. US retirement accounts are more flexible. If you do want to take money out before 59 and a half, you can, but you will have to pay a 10% penalty in addition to any income tax that's due on the withdrawals, but you can get access to it for a 10% penalty. There are also certain circumstances where you can get access to it penalty free. So I think one of those is if you want to take money out to buy your first property. I think there's certain limits, but you can take money out to buy your first property. You pay the income tax, but there's no penalty. And 401ks very often have a loan facility. So similarities, but also some significant differences. Most especially in trying to gain early access. And I think there's some pluses. I think that there's some real benefits to not being able to get access to UK pension at all prior to age 57. But also, I've seen situations where it's been very useful to people. So swings and roundabouts, but differences to be aware of.
Yep. Yep. You want to know your options, right? Optionality is big when you're planning, certainly as you get closer to retirement. Going to move on to contribution limits here. UK is fairly straightforward. Annual limit is £60,000 or your total earnings, whichever is lower. That can taper off for higher earnings. US, going back to our favorite theme from the start here, varies greatly by account type. some of the most common ones, a lot of people on the call, I'm sure, will have access to a 401k, right? So you have 23,500 as a limit for your contributions. Your employer contributions will be above and beyond that. 7,000 for an IRA in 2025. There is also this idea called catch-up contributions after age 50, an additional 7,500 for 401k as an example. Secure 2.0 Tax Act actually expanded that also for ages 60 to 63. So there is complexity here, but certainly you want to understand, going back to this idea of optionality, what is your eligibility here to contribute to the tax benefits of a retirement plan. We keep coming back to this idea of Roths. For high earners in particular, there are strategies such that you may have access to these accounts where before you might not have understood that. Backdoor Roth is something that people tend to throw around, right? That's a term you might hear. In short, it's a method to bypass earning limits for IRA eligibility, right? Something we use fairly often for our clients. In something of a Hollywood sequel naming piece, there's a mega backdoor Roth. Probably less people have heard of this one. Long story short, these are well-worn strategies for high earners to ensure you're taking advantage of every opportunity available to you. People and everyday investors, every day we have these conversations, Richard. I know you can attest to this, where you are leaving dollars on the table, certainly from a tax optimization perspective, that you should be taking advantage of, and that's something that we want to help our clients maximize, quite frankly.
I
How
can't
about
remember if you said this earlier, James, but just so everyone's clear, a Roth IRA is what we would think of as an ISA. I mean, they're not the same. One is an actual retirement account, and an ISA is not a retirement account. But an ISA, we put money in post tax, so it's money that's been taxed. It grows tax free, and you can take money out of it tax free. You know, fantastic accounts in the UK, fantastic accounts in the UK. And a Roth is there are some differences, but broadly that is how a Roth works. Post tax money goes in, it grows tax free. You take it out tax free. Also, awesome accounts. So
the,
you want to
the
get money in
the
a Roth is what the point we're trying to make.
the great dramatic irony, right? That Roth accounts in the U.S. are so beneficial for investors, right? Their direct analog or closest analog, let's call it, in the UK, can cause a number of downstream issues for expats in the States. We know
Oh
we've
yeah,
talked about in the past,
yeah,
ICEs and the complications there for U.S. investors.
yeah. If anyone listening to this wasn't on our last podcast, wasn't on our last webinar and hasn't heard us talk about this, if you have an ISA in America, it can be very problematic. Not always, but often really problematic. So if that's you and you want to know more, just reach out to us. It's not for us to cover on this one.
Absolutely.
Although if someone asks a question at the end, I will do. Right. Control over investments. Well, look, generally, I'm going to talk more about the scope of investment opportunities here, because for the most part, the both systems, the member, you, me, the investor, has control over the investments. It's more the what investment options are available differs dramatically depending on the account type. So most often these accounts start as in the UK a company pension scheme. Or in the US, a 401k, 403b. I'm talking about the same thing there. You know, a pension, a retirement savings scheme that is established by your employer. They save into it, you save into it, and they control it. But really, you can still pick the investments. But generally, that will be from I mean, the ones I've experienced, a very limited range of investments. And often heavy use is made of all-in-one solutions, target date funds, which can be great, but also can have real drawbacks and shortcomings. The way to get around this is once you no longer work for that company, or to move those retirement savings into a different vehicle. In the UK, we call that a SIP, a self-invested personal pension. And in the US, we call it an IRA, an individual retirement account. And these are basically vehicles to consolidate your various pension/retirement accounts and then gain access to a much, much wider investment universe. There are still restrictions. These are still regulated retirement savings accounts. You cannot invest in anything that you want. I've had some strange. I think we're near the top of a bubble because I've had some very strange conversations this week about what people want to put in a SIP. But that aside, you have a huge universe to choose from. ETFs, mutual funds, direct stocks and shares, bonds, that type of thing. Not restriction less, but certainly extremely wide, and that can be selected by you, managed by you and or your advisor. And another benefit of the SIP is you can also, for an international SIP for US people, you can also change the currency. So you don't have to get locked into pounds. You can change it to dollars, invest it in dollars, withdraw it in dollars, and that can be materially important for US investors.
Absolutely. Very, very easy to overlook currency conversations and complexities. Number seven, employer contributions. UK, sure, again, a lot of people are familiar with these. Employers are required to pensions under auto enrollment rules. Employer contributions in the US, on the other hand, this is a key difference, are optional. Okay. And they can vary widely, again, by plan type. The most common form that we often see, let's call it a 401k, is some level of employer matching, right? So you contribute 6%, employer matches 6%, or you contribute 8% and they match half of that. There's different flavors that can manifest all down to the plan rules. You want to make sure you are taking full advantage. Again, going back to that idea of, especially for high earners, those tax benefits are nothing to be sneezed at. People leave dollars on the table if they're not taking full advantage. Obviously, it's not always the priority to understand, okay, what is my 401k? How does it work? How do I enroll? But when you do get settled in the States and you're working here, you want to be sure that you have a firm grasp on it. Many of these plans now operate under what they call an opt-out regime, right? So you get automatically enrolled, but a couple of things, it might not be maximizing your employer contribution. So those are dollars left on the table. And number two, if you're not, that's not all plans. So if you're not automatically enrolled, there is some legwork then to go ahead and make sure you are contributing to that plan type. Okay. The big one, the biggie.
He says that because there's a major change coming here. It's going to catch out a lot of people. So I'll start with the US because that's not really changed. Retirement accounts in the US form, but are included in your estate when you pass away. So potentially there can be a 40% US estate tax on retirement accounts. Furthermore, when your beneficiary, so you pass away, your beneficiary inherits your account, they will be subject to income tax when they withdraw it. So there's potential for double taxation here, estate tax and beneficiary income tax when they withdraw it. However, in reality, that will happen in a tiny minority of cases because the US exemption from the estate tax is about $15 million per person. So that will catch out hardly anyone. Oh, sorry, something else to be aware of though as well. If you do inherit or whoever inherits an IRA or a retirement account, there's usually an accelerated withdrawal. But they usually have to withdraw all the funds within a certain time period. So they can't just leave it to grow indefinitely. That's something to be aware of, and if they don't, they can suffer penalties. Now, where this is changing, I think this is going to have some real impact in the next few years for for Brits in America, is historically, well, sorry, historically, and actually the situation as it is right now, inheritance tax in the UK doesn't apply to UK pensions, UK retirement accounts. What happens is if you, the pension member, passes away before 75, you whoever inherits your retirement account, your SIP, let's say, they can take those funds out tax free. Fantastic. And if you pass away after the age of 75, fingers crossed, it's less good for your beneficiary because they are then taxed on the withdrawals at their marginal rate of income tax, which is still pretty good, I think. However, this is going to change from April 2027. UK pensions are coming within the purview of inheritance tax. And inheritance tax in the UK is 40%. And what we call the nil rate band, the exemption amount, is £325,000. So potentially, if you have £1 million SIP and you pass away, now assuming you have nothing else in your estate, £675,000 or whatever it is going to be included in your estate and taxable at 40%. Furthermore, if you are over the age of 75, whoever inherits that SIP, which will be net of that tax, is then going to pay income tax on their withdrawals as well. This is a double whammy that's come out of nowhere. And because the UK nil rate band is so low, anyone with a substantial SIP is going to get caught up in this. So this is something that people are going to have to start thinking about and planning for. And there's always strategies to mitigate, if not avoid, these kind of taxes. But this is coming down the pipeline.
It's one of those things, Rich, where we don't want to lean into speculation, but when it first came out, some people thought it was a mistake. That's how sort
Mm.
of out of left field this came, this idea of double taxation. It appears that it was not. And this is something that we will have to contend with. And certainly expats who have UK pensions still
So we
need
did
to think about.
I did a podcast with a US UK estate planning attorney called Aidan Grant just after the UK changed these rules. If anyone doesn't listen to it, we have a podcast called With the Brits in America. You can go back and find this episode. And this new regime had just been announced, of which this UK pensions falling under inheritance tax was part of. And he speculated that this was a mistake. But it's since then it turns out it was a mistake. And this is the other thing to be aware of if you have a substantial retirement account or SIP from the UK. The UK is scratching around to try and raise more tax revenue right now. Pensions are an easy target because no one thinks someone with £1 million, $1 million pension SIP, no one feels sorry for them if their tax burden is increased. Yeah, you and I know £1 million doesn't buy what's that, £40,000 a year, £50,000 a year. I mean, meaningful, but not sail off into the sunset money. But the general public in the UK, they just hear £1 million in a SIP. Oh yeah, tax it. So the situation the situation is deteriorating, I'd say, in the UK for people with retirement assets.
On that sunny note, we'll land on number 9 here. Everyone's favorite topic: tax reporting complexity for expats. Um, the takeaway here, and I'll touch on inheritance because this is something that we talk about as well, but essentially, foreign financial accounts, if you are a US person, any kind of foreign financial account, be it a pension, be it a bank account, be it some other kind of financial asset, has to follow very strict reporting requirements every year to the IRS. Okay.
Even if no tax is due.
Even if no tax is due, even if you're not taking income. Richard, you can, I'm sure you agree with me on this. One of the most common misunderstandings we encounter on a weekly basis is, oh, I have this pension. It's been sat there for 10 years, 15 years. It's invested. It's up and moves up and down. I haven't taken any income. I haven't taken any withdrawals. I haven't bothered filing any FBARs or 8938s. You absolutely want to be sure that you are in offshore compliance and reporting these accounts on the forms you need to. Because frankly, going back to this idea of the US tax system being draconian, punitive in some respects, penalties, fines, interest, um, they can stack up very quickly. It leaves your statute of limitations open so that the IRS can draw previous tax years back into an audit or review. The takeaway here being that you do not want to head into retirement with these kind of things hanging over your head, right? You can do all the planning in the world, but if there is some unexploded landmine in your path that you don't see, it can cause things to go astray. It's one of the things we come back to for our clients time and time again, for the people we work with. It's not fair, right? There's no commentary on the system as it stands, but it is the truth, and you want to be sure you're navigating that system as best you can to avoid the very worst of these penalties.
James, we just had a question, which, by the way, I'm pleased about because I've never done a webinar without a question along the way. And we got to point number 9 with our first question. I'm not sure that's a good thing or a bad thing,
We should
so I'm glad.
don't be shy. Let's repeat it. If you have
I'm
questions.
just going to. So the question is, does the IRS reporting apply to UK state pension? Yes. Right. So, but I'm just going to clarify this further. What James is talking about here is something called informational reporting. So this is not reporting an income. This is if you have bank accounts This is if you have retirement assets. This is if you have ISAs. This is if you have what else is on there, James? Stock portfolios, non-US stock
Business, right? If
portfolios,
you have some kind of business.
a non-US business, non-US partnership interest.
Mhm.
Even if no tax is due, even if there's no income, even if there's no capital gains, these accounts generally have to be reported every single year, just the balances on multiple forms. There are limits, but the limits are the thresholds, but they're quite low, so it generally catches people out. And it's still, I've been doing this for 10 years. Still, on a weekly basis, we find people who are not aware of this, and it's hard. I fully sympathise because this is not a requirement of anywhere else in the world that I'm aware of. That being said, what we've been asked here is if you get a UK state pension, you are getting a non-US income stream that absolutely has to be reported on your tax return. That is a taxable income. It doesn't matter whether it falls within your personal exemption in the UK. As a if you're a US if you're living in the US on a visa, if you're a green card holder, if you're a US citizen, you are your worldwide income is taxable, and a UK state pension is worldwide income that goes on your 1040 and is taxable. But that's not what James is talking about here. James is talking about informational reporting.
Yep. Yep. Good distinction there.
Quick question. So do all pensions, including EPP, is that employer personal? What's EPP? State pensions need reporting even if not drawing down. Well, your state pension, we're not, I just need to say here, we're not tax advisors, folks. Although I don't think we're crossing a line here. But if your state pension is not, you don't report that if you're not drawing down on it because there's nothing to report. There's no asset there. If something has you executive pension plan, I don't know that it's going to depend. I'd need to know more on the details of that specific plan. Broadly speaking, right? If there is a balance, if it's worth £700,000 or dollars, it has to be reported on an informational return. If there's no income, then obviously there's nothing that flows through to the 1040. If there is an income as well, then that's a separate item on the 1040. I think, okay, well, we've gone from no questions to a lot of questions. Are there UK reporting requirements for US state pension? Um, Oftentimes no, because if you're just getting a UK state pension, very often that will fall within your personal exemption in the UK. So there's no tax in the UK, therefore there's no need to do a UK tax return. And it's because it falls within that personal exemption in the UK that I've found oftentimes people in the US think, oh great, that means I don't have to worry about it in the US, and that's absolutely not the case. Just because it falls within that UK personal exemption, it still has to be reported in the US on a US tax return. It just means there's no UK. Now, if you have other UK income though, and stack that income on top of each other, and you get into the taxable realm, then there may be a requirement. But just standalone UK state pension, no. Okay. What about defined benefit pensions that are not being drawn down on? I think I'm being asked here if you have a final salary pension, a defined benefit pension that's not paying an income, because once it's paying an income, that has to be reported, obviously, on your 1040 income. Now, the, I have seen tax advisors disagree on this. I have seen some tax advisors go through an abundance of caution to calculate a nominal value to your final salary pension and put it on FBARs and 1040s. That though is the exception. I'm not a tax advisor, but I have generally experienced tax advisors who have said if you're not drawing an income on it, until then, because it's got no intrinsic value to you, it doesn't need to be reported. Essentially, it can't be reported. I'd rely on your tax advisor for that, but that's what I've seen. I'll tell you what, James, let's finish up and then come back to these. We've got a couple more
Okay.
questions here.
Yep.
We'll just finish up, guys, and then we'll come to these questions. One about
And keep
PCLS.
them coming. These are good questions. So if you're listening,
Yeah.
we will, like I said, have a dedicated session here, and we will get to the other few that have come through.
Came thick and fast then.
It's a great time to talk about optimization.
Okay. Well, I'll zip through this. I've been doing this. I mean, I've been a financial planner now for crikey, 20 years. Wow. Nearly 20 years. And I've been doing it in the US for 10 years. It's really different in the US. Really different. I've done it in in three countries now, and it's just different here. It's way more complex. There's way more opportunity here as well. But the flip side to that is it's more complicated, and the cost of getting it wrong are much higher. I'm absolutely convinced. Expats are means to really take advantage of the system, to really make the most opportunity of living and working here. You need a cross-border, not just a local domestic, but cross-border financial planner, tax advisor, and estate planner. Now, the estate planner is more transactional. They're needed every few years, but you want all three of these folk to have cross-border experience and knowledge, and to have a relationship with each other about you, and to be in communication about you, and to be proactive about you. If you do this, this is how I believe you can take advantage of all the opportunities whilst avoiding all these expat landmines that can trip people up year in, year out for decades. And that is how you really make the most of this opportunity. And done that way, that should the benefit in that, the return in that should be multiples of any fee you pay over a lifetime. And this is what we do. We're a financial investment person in this relationship, but we put together these teams of cross-border professionals for our clients and then manage them. Or we can work with existing advisors, which we can do. But we can put this together, put the team together, manage the team, optimize your affairs, make sure you're avoiding all the landmines that give people sleepless nights with good reason, and make the most of this massive opportunity.
And on that note, as I promised, QR code. This links directly to our diary. As I mentioned at the start, obviously your facts and circumstances are unique. We are offering this to all attendees of today's webinar. It's a no cost, no obligation exploratory Zoom. We'll get to know more about you, what you're looking to accomplish, and we'll have a chat about how we might be able to help. If you like QR codes, like I said, that links directly to our calendar. If you're allergic to QR codes, which I know some people are, I'm not a huge fan of them on menus myself, but you can email us. My email, james@planfirstwealth.com or richard@planfirstwealth.com. Put in the subject line meeting. We'll reply and get something booked in. So I will pull this up again one final time prior to close today, but that QR code is available for you to book in with us. And now we'll
All right,
move to Q&A.
so we've got a couple of questions about 25%, which I'll come to in a second.
Mhm.
I'm just going to answer this question. I understand if taking the UK state pension income is reportable, but if it's not being taken, is it treated the same as a pension or bank account and needs to be reported on FBAR? If it's not being taken, no, I don't believe so, because you have nothing to report. You have no balance, right? You can't say, oh, I have a. I mean, I guess what you're saying is I'm 68. I could be taking my UK state pension, but I'm not. Therefore, do I need to report it, the value? But there is no value. You know, you can't point to an account and say I have £10,000 in this nominal UK state. That doesn't exist. Just once you're receiving the income, then that needs to go on your 1040. 1040 being the income tax. Right. PCLS. 25% lump sum. Have you seen an example of a client taking UK PCLS tax-free in the UK and using the UK tax treaty successfully to ensure it remains tax-free in the US too? So, the question is, have I experienced clients? There's two parts. Have I experienced clients taking PCLS tax-free, and have I seen it be done successfully? The answer to the first question is, have I seen it done? Yes, many times. Have I seen it done successfully is harder to answer, because the way the US system works is you submit your tax return, and then if the IRS have a problem with it, they'll come back to you. And that can happen because they pick something up proactively or you get selected for audit. So it's hard to say whether it's been successful. I've never known a client be challenged, but that doesn't mean that one day it won't be challenged. And that's why it's so important to, if you're going to take it tax free, to work with a professional and to document it correctly, for two reasons. One, if it's challenged, there's no argument of fraud because you've jumped through all the hoops to correct it, so there's no potential fraud penalty. but also to ensure that the statute of limitations clock's ticking. So if you do everything correctly, if your return is absolutely spotless and done properly, there should be a 3 year statute of limitations clock ticking. And then once you're out that period, even if they challenge it, it's too late. If you don't submit the right forms, if you don't declare it in the correct manner, that can cause the statute of limitations clock never ticking, which would mean that if they pick it up 5 years later, 6, whatever, they could come back to you and challenge it. So that's one reason why it's really important. Now, have I seen them using the treaty? Yes, yes, I have. I've seen clients use tax professionals to do it. This is one of those areas where the tax treaty is ambiguous. It's a grey area, and there is an argument to be made that it's tax free, and there is an argument to be made that it's taxable in America. And in my experience, people really don't like this ambiguity. People want a yes or no answer, which I understand. But also, you have to think this ambiguity works in your favour. It's better than a flat no. That being said, it should also be noted that the IRS have said, I think there's a communication out there from them, their position is it's taxable. But there are some really good cross-border tax advisors who argue that there is a supportable case that it's not. But this is the thorny area that you're in, and this is why it's really important to work with a professional who understands this. It can help you navigate it and help you understand that if you do take it tax free, you know you're in opposition to the IRS essentially. But this is the case for it, and if you feel comfortable with that, this is how we do it. And I'm sorry it's not clearer than that, but I suppose that's better than an outright no. Also,
Richard, just to underline that, because this is such, and we know, having done these webinars for many years now, this is such a hot topic. Our understanding as well. Let's say you take this sort of, you're going to excuse the Americanism, you take the cowboy approach. I'm going to take PCLS. I'm not going to declare it, or I'm not going to take the treaty position. If these steps are not filed and done correctly, the IRS will approach that scenario, an audit, for example, as if there is no treaty protection at all. So it's so critical. And I know we're kind of piling on here, but you want to make sure you're taking all the steps necessary and doing it correctly. It's not an easy thing, because A, you want your statute of limitations closed, and B, you want to be able to invoke that treaty protection if that's the position you're taking, and be able to defend that position to the IRS if and when you're asked.
hmm. Hmm. Is there a cost for putting the team of contacts? There's no cost for I will happily share any and all contacts with you. Cross-border tax advisors, cross-border estate planners. There's obviously cost for advice though. So if you engage cross-border professionals, there'll be a fee for advice, but there's no fee for making contacts and sharing those contacts. Can you speak more about the best method to transfer over a personal pension plan withdrawal, including the 25% tax-free part and reporting requirement in the US, assuming already at retirement age? Okay, I'm not sure if I understand that. You think that's someone asking if they've got a personal pension, what should they do with it?
So I'm reading that maybe similar to, there's a question a little bit further on here. Can you roll over a UK pension into a US IRA? These are, I'm
Oh,
thinking of this as like, if you're a US expat, if you're in the US and
yeah.
you're an expat, how can I access? What should I do with my
Okay. Yeah.
pension?
Right. No. So if you have a UK pension, that has to stay in the UK. If you have a US retirement account, that has to stay in the US. You can't roll a US retirement account into a UK SIP. You can't roll a UK pension into a US IRA. So if you're in the UK and you have legacy, I call them legacy UK retirement pensions, company pension schemes, personal pension schemes, stakeholder pension plans, if anyone has those, you generally what people will do is roll them into a SIP that allows US members, and therefore you get currency flexibility as well. And then from the SIP, you can then withdraw. You can invest and withdraw the funds. Some of these old style pension plans in the UK will allow you to take a drawdown, but that's relatively uncommon. And you can no, actually, I was going to say you can buy an annuity, but in my experience, you as a US resident, you can't buy an annuity. So generally, you've got to get it out. You got to get it out into a SIP.
There are, just to underline that, there are ways to have it sitting alongside within your plan, so to speak, your U.S. assets. The kind of goal, what we help our clients accomplish is having these disparate buckets of money: U.S. IRA, U.S. Roth IRA, U.S. brokerage account, U.K. pensions, U.K. SIPs, U.K. GIAs potentially. All of it coordinated and aligned under one plan. There are ways to do that. Absolutely, international SIPs a common way to do that. So while you can't do it directly, there are ways to manage it in a way that's not, that's feasible, that's manageable.
Jackie, no longer a US expat, living back in the UK. Although Jackie, if you are back as a UK citizen, US citizen, then that will have consequences. But let's assume you're not. I have a modest 401k plan. Want to know if it's possible to bring the balance back tax free, transfer it to a personal pension. No. So your 401k is going to, okay, great. That makes life a lot easier for you. She's sorry, everyone. She just said not an American or green card holder, which makes life much easier. But the your question is you can't move that 401k into a UK personal pension. You'll have to leave it as a 401k or roll it into an IRA, and that could be challenging for you as a non-US resident. It's also worth noting that when you take withdrawals from a 401k, they will, I think they will apply a 30% withholding tax at source that you won't be able to reclaim. But even if you roll into an IRA, it's still taxable. And oh no, sorry, Jackie. And I'm saying this. I'm thinking that there could be you might not be able to move it into an IRA because you are no longer a US person because the US sees that as going out their tax net. I don't actually know the
Very
answer to
likely
that.
you're going to suffer withholding at source, right? 30%.
Yes,
There are
at
ways
the
to
very
manage
minimum.
that. There's a W-8 Ben you can file, but it's
I don't
still going
think
to be
when it's a 401k though, I think it's auto. I think if it's 401k
auto
specifically,
30%.
with an IRA, we can do an
Yeah.
IRA, the form you're mentioning. I think it's an automatic 30% withholding from an IRA from a 401k on
Yeah.
withdrawals.
And to make matters more complicated, HMRC has issued guidance recently on what they define a lump sum that would suggest, again, not a tax advisor getting into speculation here, would suggest that HMRC may start to assess taxes on 401k distributions for a UK resident as a UK tax resident. That's our rough understanding. Yeah, so no way to get it tax free. The tax will be owed, and you want to work with a tax advisor to make sure that you're not paying double tax where you can avoid it.
I'm trying to work that one out in my head. There's got to be a way. Um, any advice, recommendations on using UK family investment companies or LLPs with UK SAS pensions for UK assets to limit or remove UK IHT and only US IHT? Wow, that's a specific one. Okay. I've not been asked about SASs in a long while. No, frankly, only because this is really quite new, and we're currently investigating ways to mitigate the UK inheritance tax. I was talking to someone this week about potential insurance to mitigate it. And I'll be honest with you, I had given it no thought to family investment companies or LPs within a SAS. So I can't answer that. I will just say things are much harder once you're in the US. Once you leave the UK, things arguably can get a little bit harder. But once you're in the US, the options available to us generally shrink dramatically, partly because of the complexities of the US and partly because UK providers don't want to deal with US persons. So it just everything gets harder. And the idea of this working in the US, my initial reaction is skeptical. But I don't. But this is the first I've ever heard of it. So I'd have to look into it. UK pension question. HMRC tells me I have claimed my UK state pension by phone. What do I do next to actually start the flow of money to me here in the US? Things get kind of stuck. I, under- I, I don't know, honestly, I'm afraid. I, I've never, I don't see how your pension hasn't started if you're not getting paid any money. I don't, I, if you're not receiving income, your pension hasn't started. So if they told you on the phone it started, you have no money in your account, in UK or US, then it's not started, as far as I'm concerned. You have nothing, you have nothing to report. I wouldn't have thought.
You'll probably have to call again, is the unfortunate answer,
We
which you
have
hear
it,
sometimes.
yeah, another. I understand the 25% UK private pension lump sum transfer to my Fidelity account is tax free in the US. Please advise. Thanks. We have spent a bit of time talking about this. I can't advise. There is no straight answer. It's ambiguous. Absolutely critically get a tax advisor involved, follow their advice and do it properly. We want to take a lump sum. We want to take as a lump sum a UK pension and bring the money to the US. Have been advised to take half this year and the rest early next year. Two different US tax years, but the same UK tax year. Any thoughts? So you're going to take out you're going to empty your entire UK pension. We're not talking about the tax-free lump sum here. We're talking about the entire UK pension. Uh, well, if you're in the right, so first of all, if you're in the US, if you're a US person and you have an NT tax code, an NT tax code stands for non-taxpayer. And it's a, right, let me go back a second here. When you withdraw money from your UK pension, you are taxed at source in the UK. It goes through the PAYE system for anyone who remembers that. It goes through the PAYE system and tax is withheld at source. However, as a US person, under the treaty, the US has taxing rights over you. So you still need to pay tax in the US and reclaim it from the UK, right? So to avoid all that, you should apply for what's called an NT an NT tax code. You have to fill out a form, send it off to the IRS. The IRS then takes 6 months to fill out their part. They then send it to the UK, certifying that you are a US person and a US taxpayer. Then HMRC eventually 6 months later will apply an NT tax code to your PAYE system, and then when that has been applied, you should be able to any withdrawals you take from the UK pension should be tax free in the US. So I do not see why it would have any bearing, why it would matter what the UK tax year was. If you're a fully US person with a with an NT tax code, the UK tax year should be immaterial because you're not going to be subject to UK tax. I mean, without knowing more about your situation, taking it over 2 tax years could make sense depending on what your income is. But it really depends on what your income is, how much you're withdrawing, what your marginal rate of tax is. But I
I
don't.
would just taking a broader view, right? We would want to ask about why is the discussion about a lump sum of the entirety of the UK pension
Mm.
doesn't that's not typically an efficient way to draw down, depending on what you're looking to do without more input there.
Do you handle transfer of UK pension into a SIP and then transfer into a US IRA? Yes, we handle transfer of UK pension into a SIP. No, we don't then transfer it into a US IRA because you can't. The best you can do is then convert it into dollars and manage it in dollars, and then it looks and feels like a US retirement account, but it's not. It will always remain in the UK as an FCA regulated entity. You cannot roll it into the US. And beware anyone who says otherwise.
Yes.
Oh wow, this is a great question. Can you talk about level of granular reporting required on FBAR? How does the structure of a UK pension, e.g., contract-based versus trust-based, affect how you simply report each UK pension and remain compliant? Wow, I love it. Great knowledge.
This is someone that's attended our
Someone who's
webinars or done their homework.
someone who's deep in the weeds. Um, I just want to reiterate, I'm not a tax advisor. Please don't rely on anything I say for tax advice. I don't do tax prep. Obviously, though, I've got a lot of experience and in this area, and I hope it's useful sharing that with you. Right. So the differentiation, the distinction between a contract-based and a trust-based pension is important, but not for FBAR, I believe. FBAR simply is asking you to report financial accounts, bank accounts, retirement accounts, investment accounts, and whether it's a contract-based or a trust-based pension. My understanding is it will have to be on FBAR, subject to the very, very low threshold of $10,000. That being said, if you have a contract-based or a trust-based pension, will have a big impact on whether you have to submit a 3520 and a 3520A trust form, which are much bigger, are much more problematic forms. They're expensive to complete. I have to complete them each year. I have a small SIP. If you have a trust-based SIP, which the vast, vast majority of retirement accounts are, then tax advisors generally agree that forms 3520 and form 3520A are required. And if you have a contract base, they generally agree that they're not. So, in short, FBAR still applies, but it could be materially different for 3520 reporting. And that's a big deal. 3520 reporting is a pain and it's expensive, and the penalties are draconian. And the IRS is horribly hot on the penalties for 3520.
Worth noting that applies to all foreign trusts, right? That kind of reporting, not just in a pension context. So if there's anyone listening that has signatory authority over a trust in the UK, for example, there are reporting requirements.
Hmm. My pension provider requires the withdrawal to be 100% or all or nothing. I have heard that an international SIP is a good idea. Why is that? Goal is to bring the money to the US. Okay, so if it's 100% all or nothing, I believe you have two options, right? You can either roll it into an international SIP or you can just take a full distribution. That might be an option depending on the size, the amount of the amount of the pension and your other income. It might be horribly tax inefficient, right? I don't know enough to advise on that. But if let's say it was 10K and you just wanted it in the US, well then that might make sense. Just pay up, just not have a huge impact. But if it's £1 million, obviously that would have a huge tax impact taking it all now, and generally people want to avoid that. If that's the case, then the only option really would be a SIP, or we talk about international SIP. Now, look, there's no actual thing as an international SIP. It doesn't exist. We talk about it to denote a SIP that will accept US residents and facilitate currency changes. The vast majority don't. So so when we say international SIP, we mean one that we know will accept US residents, and we know one that will allow us to change the currency into dollars or withdraw in dollars. So that's why you do it. That's why you move it into an international SIP. So you didn't. There was no tax consequence on doing that, and then you could manage it yourself or have someone else manage it. You could have it in dollars, etc., etc. If the goal is to bring it into the US, your options are either, well, you can't roll it into an IRA. If it stays in a pension wrapper, it's staying in the UK. If you are going to withdraw the funds, bring it into the US, the only option I'm aware of is to take that money as income, pay tax on it, pay income tax, and then you bring it into the US, but you pay tax on it. Now, in my experience, when we're talking about, we sometimes we have clients who have got relatively small retirement accounts, almost like, and eventually they just want to be done with them. They add reporting complexity. They're not as efficient as US accounts, so they just close them. They take the tax hit, they bring it to the US. But once you get into the larger amounts, hundreds of thousands, millions in these accounts, the tax hit to bring it to liquidate it and bring it all to the US is so significant that people don't want to do that. And then it makes much more sense to have it in an international SIP and manage it as if it were a US retirement account, but it's not.
Good, excellent. Look at that timing too.
I feel
12:15.
gratified, everyone. Thank you for all those questions.
Yes, yes.
As we started point nine, I thought, oh, we've misjudged this. I thought this was some good stuff, but then the questions came flying in, so I appreciate that. Thank you.
Very good questions too. We appreciate everyone for attending, everyone for sending in questions. Just a reminder, today's webinar recording will be sent out to all registrants. If you have questions, as inevitably I know people walk away from these things, we talked about a lot. Some things are rattling around your head. If questions come up, please feel free. Again, I'll close on the QR code here to link to our diary, or like I say, send us an email. James at planfirstwealth.com, Richard at planfirstwealth.com. We're happy to have a chat and talk through what we talked about today and more. Richard, any final comments before we close out?
No, thank you everyone for attending. Thank you for those questions. If we can be of assistance, even if it's just a question, please reach out to us.
Absolutely. All right, everyone. Thanks again. Look forward to speaking soon. Take care.
Cheers.